The dollar's dominance isn't being replaced, it's being quietly bypassed, and the market is only now pricing the consequences. Because there's a force working overtime to frame this as noise, as politics, as a slow-motion nothing burger, central banks talking, trade ministers posturing, social media doom. But the real shift is not happening in speeches. It's happening in the plumbing. And once plumbing changes, headlines don't matter. The hidden mechanism is simple and brutal. China doesn't need the renminbi to become the world's #1 currency to dismantle dollar dominance. It only needs the dollar to become optional in enough transactions that the marginal bid for dollars fades. That's the part most people miss. And before we're done, you'll have a concrete checklist for the next 1 to 2 weeks. What levels matter, what confirms the thesis, what weakens it, and the one kind of calm price action that should actually worry you more than a sell-off. Because if a single set of pipes clogs, funding, collateral settlement, the math changes. And that's where the real pressure starts. Dollar dominance isn't a patriotic slogan. It's a system with multiple layers, and you only have to crack a few layers to change the whole incentive landscape. Layer 1 is invoicing, what currency trade contracts are written in. Layer 2 is settlement, what currency actually gets delivered at payment time. Layer 3 is messaging and rails, which networks move the instruction and clear the money. Layer 4 is funding and hedging, what currency the world borrows and hedges in when stress hits. Layer 5 is collateral, what assets are accepted everywhere, at scale, at low haircuts, with deep liquidity. The US dollar still sits at the top of several layers. But the point is not top. The point is dependence. Dependence is where pricing power lives. When dependence fades even at the margin, dominance erodes without a dramatic collapse. And that's why you better seeing something that looks contradictory on the surface, gold ripping to record, territory into late December and starting 2026 strong, while the dollar itself begins the year soft after a historically weak 2025. That combination doesn't happen in a vacuum. It happens when the market starts to treat dollars everywhere as less certain. Not tomorrow, not in a meme timeline, but in a corridor by corridor, settlement by settlement way that compounds. And the compounding is the story. But that's not the part that matters most. The part that matters is how quickly a small shift in settlement behavior can cascade into funding behavior. And funding behavior is where the dollar AS real teeth are. If you want the current tape read, it's not subtle. But here's the trap that makes people complacent. They look at global payments, shares, and see the renminbi still small, and they conclude nothing is happening. That S-like looking at a single road and concluding a city hasn't grown because the highway is still busier. A new road can reroute the most important cargo while the main highway remains crowded. The renminbi AS share of global payments by value has been hovering in the low single digits, recently around 3%, and it still ranks behind the big four. That sounds unimpressive if you're waiting for a dramatic overthrow. But if you understand network formation, it's the early middle innings of a corridor strategy. Targeted trade lanes, targeted commodity flows, targeted partners with high sanctions, sensitivity, then gradual normalization. And that's not the part that matters most. The part that matters is that these corridors tend to be the very corridors where the dollar OS coercive leverage used to be strongest. When the very actors most motivated to avoid the dollar also control meaningful commodity supply or demand, the incentive to build alternatives goes from theoretical to urgent. Energy is the classic example. When oil and gas flows are politically constrained, settlement becomes political too. If China can keep energy intake flowing via non-dollar settlement arrangements, whether through direct currency settlement, swap lines, or intermediary clearing structures, that's not a press release victory. That's a stress test of the dollar system, and each successful stress test builds confidence. Confidence is how money regimes shift, quietly, step by step. But the next detail is what flips the whole setup. Because the dollar's dominance is not just trade settlement, it's reserves. And reserves don't move fast until they do. The latest reserve composition data has shown the dollar share edging lower, sitting in the mid-50s% range, while other buckets, euro, yen, and a growing other currencies category, take small bites over time. That's not a collapse, that's a drift. But drift matters when the base is huge. A 1% shift of global reserves is not a footnote. It's a sea of duration and collateral preference moving. And there's a second-order effect people ignore. It is not only what currency reserves are held in, it is how reserves are used in crisis. If a growing set of countries believes their dollar assets can be frozen, restricted, or politically weaponized, they will treat those assets differently. They might still hold them, but they will pair them with assets that cannot be frozen. And that's where gold comes in. Gold is the settlement asset with no counterparty, no switch to flip, no permission required. that SY central banks have been buyers for years, and China, IES behavior has been especially notable. Chinese demand shows up in multiple ways: official reserve additions, import flows, and the physical market's premium discount behavior relative to global spot. Recently, there have been reports of China's gold imports via Hong Kong jumping month over month, and the local premium flipping back positive after a period of discounts. That matters, because premium behavior is the fingerprint of physical demand meeting physical availability. Paper price can move on positioning, premiums move on reality, and if you're trying to understand the real shift, you always track where paper and physical diverge, because that divergence is where the pressure starts. This is where we get concrete and finance literate, because the audience this video is for doesn't want slogans. They want mechanisms. So let's talk about the dollar's real power: funding and hedging. The reason the dollar becomes king in crises is not because everyone loves America in a panic. It's because dollar liabilities exist everywhere. Corporates borrow in dollars. Banks fund in dollars. Emerging markets issue in dollars. Commodity trade is financed in dollars. Derivatives are margined in dollars. When volatility spikes, margin calls come in the currency of the contract and collateral agreements. That creates forced dollar demand, not preference, forced demand. This is the dash for dollars dynamic, and it's why dollar strength often appears precisely when risk markets are falling. Now here's the mechanism that matters for our story. If China and a wider block of partners can shift meaningful trade and financing toward non-dollar settlement and build reliable rails to do it, they reduce the amount of forced dollar demand that appears during stress. Not eliminate it, reduce it, at the margin. And at the margin is where price is set. Every market is priced at the margin. Treasury yields are set by the marginal buyer. FX rates are set by marginal flow. Credit spreads widen at the margin. If the marginal forced dollar bid weakens over years, the dollar's crisis strength reflex becomes less dominant. That is dismantling dollar dominance without a single replacement moment. And that is the hidden detail mainstream misses, because it's not cinematic enough for a headline. But it is cinematic enough for your portfolio, because if this one level breaks, the math changes. Now let S address the timeline implied in the title 2026 to 2040. That S not a day trade call. That's a regime shift window. Regime shifts are messy. They lurch. They fake you out. They produce violent squeezes in both directions. They create moments where the dollar spikes hard because stress hits and the old system still matters. Then they create moments where the dollar fades even as yields stay firm because the underlying dependency is quietly lower. This is why you need a two-lens model: near-term market structure and long-term plumbing. Long-term plumbing is what China is building: rails, swap lines, trade invoicing structures, commodity settlement experimentation, and potentially digital settlement layers. Near-term market structure is how funds, banks, and hedgers are positioned today, right now, this week, around yields, the dollar index, and metals. And the calendar is the catalyst for when these collide. We are at the year turn. Early January is notorious for thin liquidity pockets and positioning resets. Books are rebalanced. Risk budgets reset. Dealers adjust hedges. Macro funds re-express themes that were crowded into year end. And thin liquidity makes moves look emotional when they're actually mechanical. That's why you'll see sudden spikes, sudden flushes, sudden gap risk. And volatility and thin liquidity is exactly how people get manipulated. But we'll get to that shield in a moment because you're going to need it. First, we stack the proof. Proof stack is not one data point. It's multiple layers that all point in the same direction, even if each layer is imperfect. Layer 1, the rails. CIPS is processing large cross-border RMB volumes and expanding participant networks. That is infrastructure growth, not rhetoric. Layer 2, payment share. The RMB is still a low single-digit share of global payments by value, but it remains among the top currencies and shows periodic jumps, evidence of corridor usage and growing normalization in certain routes. Layer 3, reserves. The dollar's reported share of allocated reserves is in the mid-50s% range and has edged down over time. Diversification is gradual, but directionally consistent. Layer 4, gold behavior. Physical flows into China and reported central bank buying trends align with a desire for sanction-resistant reserve assets, and physical premiums provide an on-the-ground check against purely paper narratives. Layer 5, price action and cross-asset behavior. Gold, starting 2026 strong near the mid-4,300s after a record near $4,550, is a statement about trust, especially when yields remain elevated. Layer 6, the dollar's own behavior. A weak year like 2025 for the dollar, especially if driven by narrowing rate differentials, fiscal concerns, and institutional uncertainty, creates fertile ground for alternative settlement strategies to gain psychological credibility. Layer 7, geopolitical corridor stress. Sanctions, trade restrictions, and strategic rivalry all incentivize building redundant settlement options, even if those options are less efficient today. Redundancy is insurance. Insurance gets bought right before you think you need it. And that's not the part that matters most. The part that matters is what this forces other participants to do. Because markets are not narratives. They are forced actions. If more trade can settle without touching dollars, exporters and importers can hold different working capital buffers, banks can offer different hedging products, corporates can diversify currency exposure, not just for returns, but for operational continuity. Central banks can justify holding more other assets, gold, non-dollar bonds, alternative currency deposits, not because they think the dollar is dead, but because they cannot afford single point of failure risk. When a system is redesigned around resiliency, dominance becomes less profitable. That's the quiet takeover. Now, you might be thinking, okay, but the dollar still has the deepest treasury market, the most liquid collateral, the strongest legal framework, and the most open capital markets. True, and those are massive advantages. This is why it won't be a straight line. This is why the dollar can have ferocious rallies inside a long-term erosion story. And this is why anyone telling you the dollar ends next month is selling you adrenaline, not analysis. There are real counterpoints. The renminbi is not fully convertible. China maintains capital controls. Foreign investors still demand a risk premium for political and legal uncertainty. China's domestic financial system has its own stresses. And liquidity matters. The world uses the dollar because it can, at size, in a crisis, without asking permission from a different sovereign. Those are not small points. They are the core reasons why replacement is the wrong framing. Because the outcome isn't binary. The outcome is a world where the dollar remains dominant in some layers, but loses its monopoly on others. And losing monopoly is losing pricing power. That's enough to change decades of assumptions. But the next detail is what flips the whole setup. The flip is that the most sensitive layer, the layer markets price fastest, is not trade invoices, and it's not reserve charts. It's the treasury absorption problem. The US runs large deficits. It issues a lot of paper. Someone has to buy it. If domestic buyers absorb it, yields can be contained, but risk spreads and liquidity premia change. If foreign buyers absorb less at the margin, yields can rise or term premium can widen, especially during auctions. And the dollar's safe status gets tested in a different way. You don't need foreigners to dump treasuries for this to matter. You only need the marginal foreign bid to be less reliable. That's how the price of capital shifts. And when the price of capital shifts, every asset reprices. This is why you must watch flows and auctions, not memes. The Treasury's own TIP data release cadence and the auction calendar become part of the macro heartbeat. In early January is where the market starts trying to infer what kind of demand will show up this year. That's why now it matters. Not because China suddenly became ambitious in 2026, because the market's sensitivity to flow and funding is unusually high right now. Metals are extended, the dollar has already had a weak year, yields are still elevated, and geopolitical risk remains a constant background hum. When sensitivity is high, even small confirmation signals can trigger a disproportionate move. That's how regime shifts become tradable, and that's where the real pressure starts. Now let's bring it down to market structure, because the macro story is useless if you don't understand how price discovery gets pushed around week to week. Think of dollar dominance, like a massive carry and liquidity trade. Investors borrow cheap in some places, invest in higher yielding places, hedge currency risk using derivatives, post collateral, roll funding. In that world, the dollar's dominance is reinforced by the fact that the deepest funding market is dollar-based. But funding markets have weak points. One weak point is FX hedging cost. If hedging cost changes, the attractiveness of holding dollar assets changes for foreign investors. Another weak point is collateral preference. If participants start to value non-dollar collateral more, they demand different haircuts, different margin terms, different clearing routes. Another weak point is settlement risk. If you believe your dollar assets can be constrained, you treat them as less perfect. Markets price less perfect with wider spreads and higher term premia. That can happen even if nominal yields are stable because the distribution of outcomes changes. That's the key. Regime shifts change distributions, and investors who only look at point forecasts get blindsided. But that's not the part that matters most. The part that matters is how volatility will be used against you. Here's the viewer psychology shield, and it is non-negotiable if you want to keep your capital intact while the macro story plays out. In a regime shift, price doesn't move like a clean trend line. It moves like a series of traps. Big up days that feel like the new era right before a brutal flush. Big down days that feel like it's over right before a squeeze higher. Headlines will cluster at turning points because media reacts to price, not the other way around. The emotional manipulation is predictable. When metals rally, you'll get bubble narratives and calls to sell right near breakouts. When metals dip, you'll get top is in narratives right near retests. When the dollar bounces, you'll get de-dollarization is dead narratives right near funding stress points that temporarily support the dollar. And when the dollar weakens, you'll get collapse narratives right when the market is overcrowded and vulnerable to a squeeze. The goal is to get you to do two things: chase at highs and puke at lows, because that's how liquidity providers eat. The antidote is to separate trend signals from noise. Trend signals are structural: rails growth, reserve drift, persistent physical premiums, sustained multi-month price structure, and consistent behavior across related markets. Noise is daily headline volatility and short-term positioning whipsaws. And you need a two-scenario lens at all times. Scenario 1 is the controlled pullback and retest. The thesis remains intact, but price cools off, key levels hold, and the market shakes out leverage. Scenario 2 is the continuation squeeze: thin liquidity, forced buying, and reflexive momentum push price beyond what fundamentals justify in the short run, creating gap risk and emotional extremes. Both scenarios can occur inside the same month. That's why position sizing and time horizon matter more than conviction. If you can't survive the volatility, the thesis doesn't matter. But the next detail is what flips the whole setup. Because the biggest trap in this theme is to make it China versus America and forget that the market's real driver is incentives. Banks, funds, corporates, and central banks respond to constraints and costs. If non-dollar settlement reduces friction, it grows. If it increases friction, it stalls. If capital controls limit convertibility, growth slows. If sanctions risk rises, growth accelerates. If the U.S. fiscal trajectory worsens and political risk rises, diversification accelerates. If U.S. growth outperforms and yields stay attractive, the dollar can remain dominant for longer. This is not a morality play, it's a cost curve. And that is why the most useful question is, what would make the dollar AS dominance reassert itself strongly? The answer is a broad global risk-off event where dollar funding becomes scarce and alternatives fail to provide liquidity. In that scenario, the dollar spikes and many de-dollarization assets can sell off initially as margin calls hit. That's the painful reality most people refuse to say out loud. You can have a long-term erosion of dominance and still get violent dollar squeezes. Those squeezes are not invalidations. They're stress tests. And stress tests are where the next phase gets funded. So what comes next? Right now, this week, this month? You need a concrete roadmap that connects the macro thesis to observable signals. Start with the dollar index behavior. The high 90s zone has become a psychological battleground. If the dollar stabilizes and reclaims strength decisively while yields remain firm, that's a near-term headwind for metals and anti-dollar narratives, and it raises the probability of scenario 1, a controlled pullback and retest in gold and related trades. If the dollar stays heavy or weakens further, even with yields holding around the low 4% area, that's a signal the market is repricing something beyond rate differentials. Confidence, fiscal trajectory, or the distribution of future outcomes that supports the thesis. Next, watch U.S. 10-year yields. If yields rise meaningfully and the dollar rises with them, that's classic tightening impulse, and risk assets can wobble. If yields rise but the dollar doesn't respond, that's a different kind of message. Term premium and confidence concerns, which can be bullish for hard assets. If yields fall sharply and the dollar falls with them, that's the easy money narrative and metals can squeeze higher quickly. Scenario 2. Now watch gold itself. If gold breaks below recent support zones and fails to reclaim them, that's not the story is over, but it is a signal that leverage was too high and the market needs a deeper reset. The invalidation is not gold went down. The invalidation would be a sustained reversal where physical premiums collapse, central bank buying narratives cool, and the dollar regains structural strength across multiple months while alternative rail usage stalls. That's a high bar. Short-term volatility won't meet it, but that's not the part that matters most. The part that matters is the checklist you can run in minutes, not hours, so you don't get hypnotized by headlines. Checklist item 1, does the RMB settlement and rail narrative continue to show expansion in participants and throughput? Not perfection. Expansion. Checklist item 2, does reserve composition continue to drift, even slowly, away from pure dollar concentration? Checklist item 3, do physical market signals, premiums, import surges, availability, stay firm even when price whips? Checklist item 4. Does gold hold up on days when the dollar tries to bounce? That cross behavior is a tell. Checklist item 5. Does the market react more strongly to funding and flow news than to political theater? That's how you know the plumbing story is being priced. Checklist item 6. Do U.S. fiscal and policy uncertainty narratives show up as persistent risk premium rather than one-day panics? If yes, that's structural. And here's the final underappreciated signal: calm. In a regime shift, the most informative moments are when the market refuses to panic, when the dollar sells off and it doesn't snap back, when gold dips and it gets bid immediately without fanfare, when yields wobble and collateral markets stay orderly. Calm is when the new equilibrium is forming. Panic is often just leverage getting cleaned. Calm is adoption. And adoption is how systems change. Now zoom out to 2026 through 2040 because the title demands a long arc. What does dismantling dominance look like across that window? It looks like more bilateral and regional settlement using local currencies where feasible. It looks like expanded use of swap lines and clearing arrangements that reduce the need for dollar intermediaries. It looks like commodity trade, experimenting with pricing and settlement options that are not purely USD-centric, especially where sanctions risk is high. It looks like a larger share of global reserves moving into other categories, gold, non-dollar bonds, and diversified currency baskets, not because everyone loves the alternatives, but because they fear single points of failure. It looks like more segmented liquidity. Certain corridors deepen in RMB settlement while global risk-free collateral remains heavily dollar-based. It looks like occasional crises where the dollar spikes hard because the old system still matters, followed by policy and infrastructure responses that widen alternatives even further. That's the rhythm. Stress, adaptation, normalization. Stress, adaptation, normalization. And every cycle leaves the dollar a little less indispensable. That is dismantling dominance, not replacing it with a single flag. But the next detail is what flips the whole setup. The flip is when corporates and banks treat non-dollar settlement not as an exception, but as a standard operating capability. When it becomes normal to invoice and settle a portion of trade without touching dollars, you don't need ideology to expand it. You only need CFOs doing what CFOs do, lowering friction, reducing risk, ensuring continuity. That's when network effects accelerate. And that's the phase the market will price hardest, because it changes future cash flows and future demand for collateral. We are not fully in that phase globally, but the ingredients are increasingly visible. The rails exist, the incentives exist, the reserve drift exists, and the hard asset bid is telling you trust is being reallocated at the margin. So what should a finance-minded viewer, retail investor, macro watcher, metals crowd, institutional skeptic do with this information without turning it into a reckless bet? You treat it as a regime backdrop, not a daily prediction engine. You respect that price can whip around violently even if the thesis is correct. You stop confusing trend with timing. You plan for the two scenarios. In scenario one, the controlled pullback and retest, the dollar bounces, yields stay firm, gold cools off toward recent support zones, physical demand steadies, and the market tries to bore you into quitting. That's where disciplined accumulation and risk management matter most, if your horizon matches the thesis. In scenario two, the continuation squeeze and gap risk, thin liquidity meets forced buying gold and silver rip beyond comfort. The dollar stays heavy and everyone suddenly discovers de-dollarization again at the exact wrong moment, right when a volatility flush can occur. In that scenario, the risk is not that you're wrong, the risk is you're overexposed. That's why sizing, liquidity, and patience are not boring, they are the edge. And here is your near-term what to watch next in one breath. Watch whether the dollar can reclaim strength meaningfully from the high 90s zone while 10-year yields hover around the low 4% area. Watch whether gold holds the mid-4 300s region and responds to dips with fast bids. Watch physical premiums and import chatter for signs of real-world demand. Watch flow and funding narratives for stress. And watch how fast headlines change when price moves, because the narrative will always chase the tape. If those signals line up, rails expanding, reserve drift continuing, physical demand staying resilient, gold holding structure while the dollar stays soft, you are watching the dismantling in real time. If those signals fracture, rails stall, reserve data stabilizes in favor of USD, physical demand fades materially, and the dollar regains structural strength across months, then the dismantling slows, not ends, because the incentives remain, but the pace changes. That's the honest framing. No guarantees, no prophecy. Just mechanisms and probabilities. And one more thing, because it matters more than people admit. This theme will attract grifters who weaponize fear. They'll tell you collapses tomorrow. They'll tell you to go all in. They'll shame you for caution. That's how volatility is used against you, first emotionally, then financially. The real advantage is calm competence, understanding the plumbing, respecting the calendar, watching the levels, and refusing to get shaken out by the exact moves designed to shake you out. If you want to be on the right side of a long regime shift, you don't need drama, you need a process. And if you're the kind of person who wants that process, who wants to track the signals, not the noise, then stay in this community, because the whole point here isn't hype, it's clarity under pressure.